Welcome back, investors. Jake here. Today's video is going to be difficult to make because I'm basically giving up on a position, and that position would be Texas Instruments. So checking in with my Schwab account, I'm currently down 17% year to date, or about 10,500. However, the account thankfully is green today, up 1,600. And the position we're talking about in this video is Texas Instruments. I own 2 call contracts with a strike of 190 expiring in January of 2023. My cost basis is 3,800 and the current market value of these contracts is 2,300. So if ever you're negative on a position, for example, I'm down 38% or about $1,400, the easiest thing to do is to sell to close. However, there are advanced options strategies to try and get back some of your money. Earlier this week, I made a video about this option strategy with Apple, where I converted my long calls that were in the money into a risk-free debit spread. With Texas Instruments today, we're going to be doing the opposite, and I'm going to turn this into kind of a risky credit spread. So before we set up that trade, let's diagnose what exactly went wrong with Texas Instruments. And my investing thesis when I got involved with this stock is the stock had uptrended nicely until about March of last year. It hit 180 a share and then was range bound and traded sideways for about 11 months between 180, 190 and a high end, a level of resistance at $200 a share. My investing thesis was as soon as the 200-day moving average catches up to the share price, Texas Instruments would start uptrending again nicely. However, you can see obviously that is not happening. And according to the stochastics, the sell-off is probably going to continue. When you just look at the moving average lines, guys, this looks really bad. If you see this occurring with any of your current positions, prepare yourself that the share price could go lower. So the 20-day is below the 50-day. The 50-day crossed below the 200. This is a death cross event according to technicals. And the 100-day is also about to cross below the 200, creating the 4 lines lined up in a negative direction. When this occurs with the charts, guys, there are large funds that will just completely give up on the stock. They don't want anything to do with it because according to their trading algorithms, statistically, stocks above all 4 of their moving averages are more likely to continue uptrending. Are people going to be shorting Texas Instruments like crazy? I don't think so. But when a stock gets below these 4 lines start acting as sell-off points. So you can see that when Texas Instruments sold off and then rebounded, it would get to the 20 or the 50, sell off, rebound, get to the 50, sell off. It's currently sold off to the level of 170. I could see it being green potentially tomorrow, getting to that 20-day moving average, and then selling off again. When we look at the chart on TradingView, this level of supports I had as a green line here at 182. This is now a level of resistance, in addition to 200 also being a level of resistance. So with the share price currently being 172, where is the share price of this stock most likely going? And it's probably not going to find support until this green line here, which goes all the way back to November of 2020, at about 162 a share. Now, I don't see Texas Instruments selling off like crazy because the stock has a really nice dividend yield of 2.71. As the share price continues to fall, the dividend yield goes up. People will buy this stock simply for the dividend. So the downside risk isn't high, but in the short term, guys, the stock isn't going anywhere. And if we experience a broader market sell-off like we did in January, Texas Instruments will sell off as well. And I'll be honest, I'm a little frustrated because Texas Instruments had a really good quarter. I was on the conference call 2 or 3 weeks ago, and Texas Instruments knocked it out of the park. They grew their revenue year over year by 18%. They beat expectations by $400 million. They beat on earnings by 33 cents a share. They gave really good guidance. Demand for their products is high and growing like crazy. Their margins are expanding. And when you look at their PDE and other price ratios, it's not too bad. Currently, the PDE for Texas Instruments is 22, which is just slightly above where it's been historically valued. Price to sales is a little high. It's currently at 9. This has been valued in the 3, 4, 5 range historically, but once again, their margins recently have expanded. Price to free cash flow, we can look at this one for fun, and it's currently at 22. When you think about other semiconductor stocks, obviously they're not, Texas Instruments isn't growing as rapidly as AMD, but I still think that this stock isn't overvalued, which is why I got involved with it back in November. But everything that is close to 52-week highs is just being sold off like crazy. This drop in Facebook, guys, I cannot get over this. So aftermarket, pre-market dropped by 24%, but for people who were saying buy the dip on February 3rd, Facebook has dropped an additional 8.7% in the last 3 days. Google had a great quarter, and it shot up, I think, like 9 or 10% in the after hours. However, since it shot up on a great quarter in which they announced a 20-to-1 stock split, it opened at 3,025, and since it opened after giving its earnings, it's down 7.5%. So this is just, I think, how it's going to be this year, guys. I think a lot of these stocks are just going to be trading sideways, prevented from going to higher highs. Whatever their 52-week high is, that is a level of resistance that traders are probably not going to entertain, that the stock prices deserve to go higher when potentially growth is slowing. So how are we going to trade this in my account when I'm down 38% on these call contracts? And what I'm going to do is I'm going to be selling calls against the calls that I bought, but they're below the strike of the calls that I bought. So if the calls that you sell are above the calls you buy, if the call's below that 150 for Apple, the calls that you bought are below the calls that you sell. This is a debit spread. When you reverse them, this is a credit spread. So in Texas Instruments, I bought at 190. I'm going to sell 2 calls with a strike of 180. Let's go ahead and execute this trade, and then I'll explain what exactly is happening here. Here is the option chain with an expiration date of January of 2023. Currently, if we look at my options here with a strike of 190, this is what I currently bought. I'm going to sell with a strike of 180 because I don't think Texas Instruments over the next 2 or 3 months is going to get back above 180. So I'm going to be selling these calls. So let's go ahead and select 2 of these. So I'm going to be selling to open quantity 2 with a strike of 180 for January of 2023. I am going to be receiving a credit today of $3,040. Let's go ahead and review and execute. Okay, what the heck is going on here? How is it even possible for me to sell and receive? The cash in my account went up $3,000. And the reason why is because these calls that I bought at 190 are acting as collateral. However, with a credit spread, you're responsible. Collateral in your account is going to be locked up for the difference between these 2 strikes. With a debit spread, the calls that you bought are always worth more at expiration than the calls that you sold, but it's the opposite with a credit spread. The calls that I'm selling are going to be worth more than the calls that I'm buying, but I no longer have unlimited risk on the calls that I'm selling. If I didn't have these calls that I bought, these would be naked calls. Your risk is unlimited if the share price of the stock just keeps going up. So your broker doesn't allow it. However, with a credit spread, if you just buy calls at a strike above the calls that you're selling, then you're covered. Your broker doesn't panic about this situation. The difference between the strikes is $10. 10 times 100 shares per contract is 1,000. I have 2 of these, so the most I can lose if Texas Instruments just takes off and goes to 300 a share or whatever is $2,000. So the calls that I bought will be gaining dollar for dollar the same amount as the calls that I sold by expiration if Texas Instruments takes off and by expiration it's above 190. However, if Texas Instruments continues to fall or continues to stay below 180 by expiration, then all of these contracts expire worthless and I basically can't lose any more money. I put in 3,871 to these calls that I bought that have gone down in value to 2,325. I then sold calls for 3,000. So what is my max loss on this trade if by January 2023 Texas Instruments stays below 180, and it's the difference between these two cost bases. So the most I can lose now on this trade is $800 if Texas Instruments never goes back above 180. You guys might be wondering, well, what happens if the share price by expiration gets to 185? $500 is the difference between the strike and the share price multiplied by 2. I would be on the hook, and my broker has already marked this collateral for $1,000 to cover that obligation should that occur. But my thinking here, guys, is that Texas Instruments is going to downtrend until it finds a level of support based on this juicy dividend that I know people are going to want to scoop up. As soon as this hits 3%, Texas Instruments is not going to keep selling off. This is a profitable company that's doing really well right now. So I think the share price of Texas Instruments will just drift into the 160s, stay in the 170s until these moving averages can catch up. I talk about this frequently. And as soon as the share price of the company can get back above all 4 of its major moving averages, then I think it's game on for Texas Instruments to go back up. At that time, I will buy to close the calls that I sold. Hopefully, the extrinsic value of these contracts over the next 4, 5, 6 months, half of it will waste away. I can net that profit and then hold on to the calls that I sold as the share price of Texas Instruments potentially this fall recovers to all-time new highs. Okay guys, I just hit you with a lot. I might make an additional video, once again with more visuals explaining step by step how I got into this trade and what exactly is happening with this trade, similar to what I made for you with the Apple debit spread. Okay, if you guys enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know. I will help you if I can. Till the next video, take care.